We all love a good story, but it could be having a negative impact on your investment returns. It could also make you vulnerable to a scam. Stories are very powerful. They can influence attitudes, beliefs and behaviours in profound ways. And as Joe Wiggins explains, it's not just children who love them.
Adults absolutely love stories, and particularly investing adults. And stories are part of the human condition. It's how we communicate with each other, it's how we remember things, it's how we interact and engage and build relationships. So they're absolutely fundamental to human society.
Pretty much for as long as we've had language, we've used stories to communicate very important things. We've used them to transmit culture, survival strategies, how we should behave in any given scenario. And what that's meant is, what modern research shows us, is that our brains are wired to deal with things in a narrative format. There's a number of benefits to doing that. We can make complex things more easy, and we can engage our emotions more easily, and also we'll tend to remember things far better.
Now, those might seem like positive things, and in many areas of life they are. But for investors, stories can be dangerous, not least because they mainly appeal to our emotions.
It is very easy to hang our hats, so very much focus on that story, without necessarily digging into it, therefore, and trying to see what the facts are behind it. And we think that we understand something better because we're told a story that we feel is based on something we understand, that we relate to.
Even financial professionals are influenced by narratives. One study by a professor at INSEAD found a direct connection between news coverage and professional trading activity.
He basically asked the question, would trading volumes shift on a day when newspapers went on strike? So obviously on a strike day there's no news. So what would happen? Would traders invest or not? So in actual fact, trading dropped 12% on that day.
Advertising and marketing professionals who promote investment products know all about behavioural psychology and the power of narratives in particular.
I think what stories do in investing is make a really complex, chaotic, uncertain world much clearer and easier to explain, even if those explanations are somewhat erroneous. So what we want as investors is a simple story of cause and effect.
A classic example of narrative-based investing is the growing popularity of thematic funds, which offer investors exposure to themes such as biotechnology or artificial intelligence. Research by Morningstar shows the returns achieved by thematic investors are consistently disappointing.
Generally speaking, these are themes that have a certain narrative hold. It's a good story. And investors are attracted to that because they like patterns. Again, they like that causality. There's a breakthrough, and therefore it's going to benefit, a group of stocks. And if I invest in those stocks, I therefore am going to benefit from that. And as I think we found time and time again in markets, it confounds logic.
Thematic funds are the issue and problem with story-based investing writ large. Thematic funds come to market after a certain element or area of the market has been performing incredibly strongly, and they're backed by a very compelling, persuasive narrative, which often attracts investor attention because, as we've talked about, past performance is an incredibly important driver of investor decision making. The problem of thematic funds is that by the time they've come to market, that theme is obviously very well known. Performance has already been usually stratospherically strong, the valuations often incredibly high, all of which is a mix for future disappointment. We tend to be beguiled by the stories, but it tends to lead to poor long-term results. One really important point to make is that we tend to mix up a story being true with it generating good investment returns, and they're just not the same thing. So if we were in 98 or 99, in the midst of the dot-com era, the dot-com bubble, was it true that the internet was going to have a transformative impact on the world? Yeah, absolutely true. Did we make money out of doing that? No, absolutely not. So being true and being a good investment idea are not the same thing.
But it's not just the traditional financial media that can lead investors astray. Digital technology bombards us with more information than we've ever had before.
Any of us who've got a smartphone can get information in their hand that a professional investor couldn't get 20 years ago. Real time, but not just from sources like Bloomberg. We can access things from X, Facebook groups, Reddit. Now, there's no doubt some really useful information in there. There's some fantastic training, some real insights, but it's buried inside a tsunami of noise, scams, and frankly, opinions that don't matter.
So, as investors, how can we protect ourselves from unhelpful narratives? For Joe, it starts with acknowledging that we're all at risk of falling for them.
At any given point of an investor's life cycle or their journey, there will be a flavour of the month story in markets that we need to be wary of. What we need to do is take a step back, think about past performance and be wary if past performance of that story is unusually strong. Think about valuations, because that will dominate the long run expected returns, and also remain diversified. Do not be concentrated into a particular story or narrative or theme. Generally speaking, they're quite dangerous, but if we think about stories in terms of shaping our own narratives and objectives and helping us make the right decisions, perhaps they can be quite useful. So if we think about them as not what's the latest in vogue market trend, but actually what's my investment story, what are my objectives, what do I want to achieve. Maybe it's something to do with my retirement, maybe it's something to do with my family and what I want to do with my family if I meet my investment objectives. So create a story about why you're investing, and hopefully that will lead to better behaviours rather than the bad behaviours that stem from short-term thematic or story-based investing.
Well, I think the starting point is always understanding the incentives in any given scenario. And I think the incentives for any modern media is all about clicking and watching. It's about getting your eyeballs on their news. And what that just means in practice is that it's maybe going to be salacious, engaging, maybe perhaps even designed to make you a little bit worried about things, because that's what makes us actually look at it. So what I would personally suggest is that most of us would do better by actually just turning things off and not looking at the news as often as we do, or looking at some online investment groups as often as we do. But if you are going to do that, I think there's two important things that anyone can do. And the first is, just like we diversify our investment portfolios, we should make sure that we diversify our information sources. The second thing that I think that we ought to do is really consciously always try and separate fact from opinion.
In short then, stay on your guard. Think about why certain commentators write and say what they do. Diversify your information sources. Try to separate news from opinion. And if all that fails, try tuning out the noise altogether.